Welcome to the Financial Foreman Ask an Expert series. I've got Jared Gray, who's a practice manager at Central Private Wealth. I like to start all my interviews by just asking, how did you get into your job, or what draws you to do what you do? So I'll let you take it away.
Yeah, it's a great question. Look, I was always interested in the stock market as a bit of a younger person, if you like. I wasn't sure how I was going to transition that into making lots of money, but that was the goal, probably like lots of people think. And then it sort of happened by accident. So I started in sales and marketing, but I had a friend who had a friend who was involved in the financial planning industry, and that's kind of how I started to find out more about the profession and the industry itself. Within about 6 months, I'd met this financial planner and got really enthused about the opportunity to use that kind of enthusiasm and passion about investments and help people. Sort of the two combinations really appealed to me. And so, within 6 months, I'd sort of done a whole bulk of training and had done a bit of an internship with a couple of firms. And it sort of grew from there, really. Turned into a plus 20-year, sort of career, moving from advice into working for different product providers to a large bank-owned licensee. It's been a long and varied career.
Yeah, nice. I guess from what I see, mainly from dealing with clients, a lot of their focus is on the asset protection space, which is the insurances. So I guess if you were to kind of simplify that sort of advice, when a client goes to you looking for, how do they protect themselves, what sort of insurance are they looking at?
Yeah, it's where most financial planners, particularly a long time ago, used to cut their teeth, because it was seen as the foundation of wealth creation, right? So if you have a really good foundation, then everything can build from that. And I think we always used to talk about, protect the assets before you've built them. And that, in a way, is what you're doing, particularly from a life insurance point of view. And an estate point of view. You really are, for a very small fee when you're younger, you're kind of buying the asset or the estate that you've not yet built, is how we used to sort of talk about it. Before you've built the $1 million of property or shares or whatever, you can actually buy that really cheaply until you've kind of got there. And that's kind of the theory behind it. But over time, more and more different products sort of came on board. And it sort of turned into not just an estate planning thing, but also like a safety net point of thing. So are you not just building an estate, you're also making sure that you're protecting your income, which is the thing that pays for your lifestyle and your building of those assets. But also they noticed other gaps like around trauma insurance, right? So we started to notice trends around the sorts of things that really impacted people's health, and also then put a big dent in their wealth creation plans. And it's all those big things, so cardiovascular, cancers, mental health issues and so forth. And so a few of those different sort of types of covers evolved as they noticed that there were these little gaps in the market for people to get the money when they need it, to help support them not just through the treatment and recovery, but also to protect their wealth creation and what they were trying to build as well.
Yeah, because I think that is the biggest risk when you look, or fear for clients is, what happens, if I'm hit by a bus or unable to work, how's a mortgage going to be paid for, how a kid's going to go to school and that sort of thing. And that forms a basis to go, okay, let's start there to try to protect that. And I guess the other stuff just flows off of it.
Yeah, 100%. Yeah, so we often get a lot of confusion. It's still an area like that's not well understood. We have a chronic underinsurance problem in Australia, and one pretty major component of that is people just don't know what's out there and what it's there for. And so, it's sort of almost hidden from people. It's a little bit like superannuation in a way. People sort of know it's there, but almost have no idea, where their money's invested, what the rules are around superannuation, portability, can I move it, how do I do that? It's kind of this sort of hidden part of their wealth journey. And so it's a sort of that initial step of shining light on that and bringing sort of more attention and education around it. And then helping people understand, well, how does it fit into your life, into your wealth creation plans, into just your general finances as well. So Yeah.
And I think it is something that's kind of ticking away in the background. You probably have, most clients have a default insurance policy, but they have no idea what the payout would be if something happens. So by having someone look at it, review it, you're kind of covered. So
Yeah, 100%. Look, I think you touched on a really important point there is the first step I find with people is that whole education piece, and that's really enlightening. People, don't realise, like for instance, they've got some default cover even in their super, which is very common. But again, I think, if I go back to that earlier stat, 75% of people don't have cover, and of the 25% that do, another 75% of that 25% are actually underinsured, right? Yep. So that means chronic underinsurance. So even that default amount, when you bring attention to it, it's really easy to highlight just how inadequate it is when you paint those pictures. If you were to die, you've got $600,000 of debt, you might have a partner and kids, that leaves them in a pretty dire financial situation. And so painting that picture is really quite easy once you're sort of able to step people through understanding what they currently got, but just then how inadequate typically it often is. So
and particularly the plan around it, because there might be 90-day waits, or talking to a client about going, okay, your insurance can be a little bit cheaper if you wait longer, but you need to have steps in place to fund that shortfall in that circumstance. So
yeah, absolutely. It's sort of all part of the planning picture, of understanding. So that's sort of the income protection. You do have levers there, and again, that's something that is part of the education piece. People feel, I think, that it's sort of a take it and then hold it as long as I can, and then if things get dire, then then I'll cancel it.
Yep.
But what they fail to sort of recognise is that it should be as much about holding on to whatever you can afford really at the time. So if your circumstances change, it's not so much all right, I'm going to scrap it all. It's very much about having that advisor in your corner to go, look, I'm spending $200 a month. Can I shave, $50 off that because I want to put $50 a month over here? Or, we're starting a family, so we're back to one income. What are the things that we can do to sort of just change the cost or the budget? And there's a range of things that you can do quite easily just to shift the levers of cover to drop the cost, but still keep that safety net in place. And again, without having an advisor to tap into to sort of recognise that it's not an all or nothing, a lot of people cancel covers that are there to protect them just at the worst possible time.
And I think particularly the trauma insurance, the TPD side of stuff, when an injury does happen or someone needs treatment, that you've got that sum of money coming in, so you can relax and kind of focus on treatment and getting better while everything's kind of being paid for is also a nice feeling as well.
Yeah, 100%. So look, let's talk about what the four are, because again, it's quite easy to now sort of quantify that there's kind of four pieces to the puzzle, and they all do different things. And the other thing that trips people up is sometimes that they can actually be used and triggered at multiple times, right? So or claimed concurrently. So the first one is life cover. It's pretty straightforward, right? You die, that money's there to help your family members. That can go to your estate. It can be bequeathed to specific people. So again, that's important to know. If you don't have a nominated beneficiary on your life insurance, it goes into your estate, and your will kind of sort of determines what happens there. But if you nominate a beneficiary, then it's not an estate asset. It goes directly to those beneficiaries based on the percentages that you allocate. So that's important. There's a little segue to that. A lot of life insurance policies now have what's called a terminal illness benefit. And that means you don't have to technically be dead, but if you have sort of a life expectancy of 12 months or less, then often those policies will allow you to access those funds in advance, which is again super handy for someone who might have terminal cancer or something, so that they can actually be involved in how those assets are distributed or managed when eventually the time comes. So really important that people don't understand that that's there. So that's life cover, right? Fairly straightforward. Probably the next one is that critical illness or trauma cover. So again, that's maybe typically a smaller lump sum. You're not dead, but you might have one of those critical illnesses, right? Or have suffered a severe car accident or come off your bike. Something that's actually sort of requires some reparations to your home, equipment, some medical care, rehabilitation costs, and those sorts of things. It could be that in relation to, say, cancer, you really need some funds to pay for pocket expenses to do something, a new treatment, something a bit radical. It might actually be an overseas clinic that provides that. None of that's covered typically by any of the services you can access here, or if you can, only partially. So we've had actually sort of close friends, family members who went to do an experimental treatment in Germany, and so it's the cost of staying there, travel to the clinic, the treatment itself, the transport to and from that country, all of that's out of pocket, and that's what that covers there to provide for.
Yeah.
And so there's a range, a lot of policies, there's a range of 30 definable, critical illnesses or traumas that you might suffer that, if you meet the definition, then that money's there to help pay out.
Yep.
And you don't have to claim on all of it. It could be just a smaller amount. Often there are some conditions, defined conditions that pay a certain small number of the insured amount out. So that's what that's there for. The next one is total and permanent disability. So often this is, it's sort of considered a fourth, but it's often very often tacked onto the life insurance.
Yep.
So inside, outside of super, it's very much, an option that you tick. Do you want to attach? It's not usually taken as a standalone cover. Yep. It's usually attached to life insurance. And again, total and permanent disability is a broad catch-all. It doesn't really matter based on a definition of something. It's just, has something happened to you that's severe enough that you cannot go back to the job that you were doing?
Yep.
So they call that an own occupation definition. And any occupation definition is much broader. So that sort of says, could you do anything, with what you're able to do or not, in terms of being able to access that insurance. And then the last one is income protection. So this is quite different again. This is covering or protecting your actual income.
Yep.
Again, it's not so much defined on what's happened to you. It's just, has something happened to you that's preventing you being able to go to work and earn your regular money, right?
Yep.
And sort of, again, this is beyond the sick leave or whatever else you might have accumulated. It's about, something keeping you out of the workforce for 6 months or 12 months or longer that's affecting your household budget. And so you could be claiming on your income protection and your trauma insurance at the same time. That's what I mean. Some people go, oh, well, can I only, sort of claim on one of these at a time? No, you might actually be claiming on your trauma for the condition that you're suffering, and also your income protection because it's preventing you going to work.
Yeah.
Now, the other thing to understand as well is what people think, if I've claimed on my income protection, is that it? Can I never claim again? No, that's the unique one. You can claim on that as many times as you have something happen to you that prevents you going to work. Yep. So it's always there as that backstop of your household budget. And so it stays with you the whole time that you need it. Always there protecting you if something happens. With the others, they tend to be what we call lump sum covers. So yes, if you've got 300,000 of trauma and you have a trauma and they pay out the 300 grand, well, your cover is now zero. You've used all those funds. They do have what's called a buyback option. So you can, in some circumstances, if you've ticked that box before you've taken the cover out, actually then say, well, I want that 300 grand of cover back, even though I've had this trauma and I've been paid that money. I want cover again for all the other conditions that might happen or instances of claim. So they're the four types of cover, and that's the safety net that basically sits under someone if they take all four and how they work together.
Yeah, cool. So, and I guess it dives into a little bit, that's why it pays to have an advisor to guide you through those processes of what you can claim, what you can't, and probably leads in nicely to like why use a financial planner versus self-managing or, just leaving your money in a retail fund and kind of hoping the best for retirement, or, using a financial planner.
Yeah, 100%. I mean, look, I think one of the main reasons, again, like if you understand that conceptually, then the next thing that hits you is it's just stuff is complex, right? So, you might go, I understand all that, Jared, that's great. I need some cover and I'm happy to look at, getting that all four as that safety net. And then, again, you might go, okay, so how do I do this? How do I actually fill out the application forms? Oh, hang on a minute. They're asking me if I want to hold this in my own name or my super fund. Well, I don't know anything about that. So the value of an advisor, again, is to help you with the things that you just don't know, and also making sure that it's in the structures and arranged appropriately. So it's not just what you need, it's also how do we make sure this is structured properly for you and your circumstances. And that's the difference between when you're trying to do it yourself and having an advisor guide you through that. Is they're a third person looking at your situation and they're able to use all the examples that they've seen in the past to help guide the decisions that you make. I think again, it's also complexity.
Yep.
Right. If you've ever seen a PDS for insurance, it's like 100 odd pages of legal definitions. All the trauma definitions. There's a lot there that just people aren't familiar with. And so again, it's about being able to guide them through the process.
Yeah, and I think it is important because you're experienced in the industry, so you can kind of guide clients down the path of where they want to be when they retire. It's not just kind of a hope, it's more defined strategy that will help them get there. Because each client has their own set of circumstances about how their lifestyle when they retire, how much money they need. So it's about tailoring it to suit that need, I think.
Yeah, 100%. Look, I mean, we've seen so many instances where, people, I guess, have made decisions about, going out and doing it on their own. Yeah. And we see so often what trips people up is again, just those blind spots. There's a lot of information on the internet, but there's a big difference between knowledge and wisdom, right? Yep. And wisdom is understanding how to put that knowledge into action. That's the difference. I think people can read up a lot online, but it doesn't also always give you all the information. And so you can develop these blind spots if you're not familiar with it, if you're not doing it all the time. And so you end up guiding yourself incorrectly into, either the wrong products, into the wrong structure. And sometimes, unfortunately, you don't find that out until the very point you need everything to work perfectly and it falls apart. And suddenly, you realise, I should have got some help doing this. Yeah. I often use the example of a mechanic, cars used to be a bit simpler to work on than now, right? But I don't try and fix my own car. I'm not an expert, but I know how an engine works. I can probably point out the different bits of it if you open up the bonnet. But I get an expert who works on, cars every day, all day of the week, and I'm happy to pay my money to get that help and guidance. Yeah,
I mean, I've seen the consequences of those self-implementation policies of clients that have made personal super contributions, rolled over to a different fund because they've listened to someone that, no, I want my money in there. And then you go to prepare their tax return. It's like, I've done personal super contributions of 10,000. They've rolled over their funds, so they've lost the ability to claim it as a deduction. And it's that point of not talking to an expert before they make a decision like that can be quite costly for them.
Yeah. Well, I mean, that's a perfect example, when self-managed super funds are on the rise. I mean, this is a bit of a segue, but again, I think somebody invalidated their fund because they bought a holiday home and then spent a whole heap of time there. So, again, we're delving into some of the complexities of self-managed super, but again, it just shows you that people know enough almost to harm themselves. And, there's got to be a bit more, sort of recognition that if you're starting to go into something that's quite complex, and whilst, as I said, even with life insurance, the general concepts are not hard for people to get their head around, there's all these little complexities that you don't know about that can really affect the outcome and hurt you. Just as I said, at the moment you actually need things to work properly. So I'm a big advocate of having seen too many disaster stories for people to just get a little bit of advice, and it doesn't have to be expensive. Particularly around life insurance, there's sort of this rise of what we call general advice, and it's an area that I've been involved in, particularly with simple needs like life insurance or just an insurance portfolio itself. And you deal with tradies, right? So they're a classic. They sort of almost do get that they work in an industry that is a bit risky. It carries risks with it. They're working on height and at heights with equipment and that sort of stuff. But they don't necessarily want to go and see a financial planner and get a full financial plan for thousands of dollars. They just kind of need some quick, simple advice or guidance as what you get under general advice to put a portfolio in place so that they can go to the work site and know that they're protected. So it doesn't have to cost you a lot of money to get the right advice.
Yeah, and I think so. That leads into my next question I was going to ask, was a little bit of a statement of advice. It's a big scary document that that you'll often see when you go to see a financial planner. There are complexities around it because of the compliance that you need to cover off. The financial planner needs to cover off. So I guess, what is a statement of advice and why is it such an important document?
Yeah, it's a really good question. Again, it's sort of, I think in general, what a financial planner does and financial advice is probably not generally well understood. I think there's still a lot to be understood by the general public about what advisors do and how they can help. But I'll start by answering your question by just defining the difference between general advice and personal advice, because that's really where the SOA comes in. Somebody who's giving general advice would disclaim to a person that they aren't taking their personal circumstances into account, which really defines personal advice. So a general advice advisor is able to answer questions, talk about general concepts, things that are in the sort of the general public or public domain they sort of talk about. And again, talk to clients about things in a general sense, use case studies and that sort of thing, but they can't give a personal directive. They can't say, you should do this, you should do that. It's more about helping guide the client with information to make the decision for themselves, right? Yeah. Personal advice is really about going to an advisor saying, look, I really need some help with my wealth creation, with an insurance portfolio, and I need you to tell me what you think I need. Yep. And that's when personal advice happens, and that has to be, an SOA has to be part of that process. So, collection of information, some analysis of the client's circumstances, and all of that funnels its way into what this document is, this SOA, Statement of Advice. So it sounds scary, and I think the intent originally when they started was that would be a nice handy little document to give to the client, with those nice sort of, clear plastic cover and bound up, that would just help them understand, well, here you are right now, and here's your goals and objectives, kind of where you want to go, and here's our expert advice about how we think you can achieve these goals and objectives over time. And it used to be divided up into that sort of short, medium and long-term goals and how we sort of are going to marry that. Unfortunately, I think the lawyers got involved a bit, and the document was really blown out and become this quite scary thing. We're talking 60, 70 pages. That's a lot for someone to absorb. A lot of disclaimers, a lot of information, sometimes duplicated. But why is it important? Well, it's important because of the bits that really matter in it. It is a legal document, so it really is, as I said, it forms part of the legal relationship you have with the financial planner. So they're very careful usually about what goes in there, because if there is any issues or a complaint, that document forms a key part of trying to understand what's gone wrong. But it's also between the advisor and the client. It's them trying to say, hey, look, I'm listening to what you want to do. We call them, your goals and objectives. We're trying to absorb that in a way that helps us understand what advice is actually going to help you get closer to those or achieve those goals and objectives. And so the important part between the advisor and the client in that document is that bit. It's the client being able to sort of recognise that the advisor's got a really good handle on who they are, where they are right now financially, but as people, and what are their motivations and goals internally, the things they want to achieve. And that they feel like that plan that's sort of put in front of them represents a good way for them to advance their situation, for them to get, ahead, whether it's financially, but also around other goals and objectives, planning for a family or, something important to them, an overseas holiday, whatever it might be. So it's an important document legally, yes, and it has sort of become, unfortunately, a bigger document because of that legal importance. But the inherent value is that process, the journey of helping clients understand themselves and their position and get them where they want to go.
Yeah, and I think that does touch on a few of the other tax strategies that I like my tradies to implement, which is, number one is paying for income protection insurance out of pocket. So that's not in your super, it builds your super balance up, but then you claim the deduction for that income protection insurance at your own marginal tax rate, which is probably going to be 32-39%, which is much better than in the super fund from a tax point of view. But I thought I'd get your take on these sort of tax strategies and why it's better to do them when you're in your mid-20s to mid-30s, and what kind of impact that will have in the longer term.
Yeah, so that's an ownership and very much a choice that sort of forms part of that individual advice or guidance. I think unless there's a real cash flow issue, it makes a lot of sense, particularly for income protection, to sit outside of super and allow the individual to claim the deduction. It makes a lot of sense. The insurance companies have come up with some innovative stuff around that. It's what they call split IP. That just simply means you can kind of now, again, if cash flow is an issue, but you're concerned, or there was an issue around income protection being held in super because of the ability to get the money out based on the rules that govern the release of money from super. It's different than holding in your own name. It also meant that, you know, if you just outright held a policy in super, you often couldn't get some of the bells and whistles that you could get on a policy held outside. And so there was this tension around, has it got to be one or the other? And so the insurance companies, I think, came up with an innovative approach, which is we almost create a dual policy. So let's say it's costing you $1,500 for that policy normally, but if we split it and create almost a mirror policy inside super and outside super, we can disproportionately move the cost to the super side. And then when it comes to claim time, they claim on that. If based on what's happening with the claim, the super fund won't pay that out based on the rules, they can then just go to your alternate or mirror policy that sits on the outside and pay it under that. And it might be, you know, $50 a month for the bit that sits outside, and then, you know, the $200 a month or whatever on the bit that's inside super. So that's a really innovative way that you can both manage the cash flow, but also any concerns around, you know, getting the money out. But from a tax planning strategy point of view, for say a young tradie who's doing really well, you know, I'm probably in step with their accountant most of the time, who will say, you know, we're going to claim this, deduct that, and let's make sure you've got a ticket for some IP. You know, make sure you're protected, and we're going to sit that in your own name. It's simple, it's clean. You know, you pay it monthly. We're going to claim it at tax time, and you know, it comes off, you know, as a deduction. So, negative gearing is just another form of that, right? So, I'd say, you know, moving on from insurance, those tax planning strategies like, okay, I want to buy my first investment property. I'm earning 150 grand. I'm starting to really push into those higher income, you know, brackets. It can make sense, right? Because you've got an asset that might be worth $600,000 or $700,000 or $800,000, growing at whatever the national average is or the local average, and it might be costing you $100 a week for you to have a $600,000 or $700,000 investment, you know, out there compounding, you know, in terms of its return. So there's a lot of commentary around negatively gearing, you know, like why would you invest in something that's actually creating an income loss? And I'd say if you're only investing for that reason, you probably want to, you know, sort of reassess your goals and objectives. But overall, particularly for say a tradie who is making really good money and they want to start getting ahead from a wealth creation point of view, there's lots of things they can tap into, but that is a good way to have an asset out there compounding whilst generating a small, maybe a small income loss. Again, that you know, then comes off their you know, taxable income. So.
And I think it is a way that they're looking at, you know, other income from other sources. You know, they're not going to be able to be on the tools forever, so they want to start to build a portfolio where they may have an income source off that isn't relying on them to be on the tools as well.
Do you think it's something that comes up more often now? People working in trades wanting to recognising that they've never earned as much money as they sort of have over the last few years, maybe the last 10 years. And so suddenly being able to build that wealth creation a bit earlier on is now available to them, so that, you know, they don't have to be working into their 60s and 70s, you know, and be sort of broken physically. Like, is that something you're getting more often?
I see more of them wanting to go into property, and then it becomes a discussion of, are we holding or are we realising the gain and selling and then doing it again? So it does become a bit of a balance there between the, you know, I think that's why it also is important to chat to a financial planner, is because you do all these things with an end goal in mind. It's not it's not one thing to just go, oh, this property's come up, I think it'll be really good, we can knock it down, build two, or do a reno flip and sell it. You know, you want a goal in mind rather than just doing it just to make profit. So let's make sure you're set up for retirement. And that's another one of my favourite tax strategies, which is just salary sacrificing, putting more into super. You know, my probably ethos on tax is we're wanting to save on tax but building wealth at the same time. I'm not necessarily big on, you know, going out and, you know, buying a new Hilux ute just to get the tax deduction when it was the instant asset write-off. I'd rather see that investment kind of done in a manner that's going to create more wealth, whether that be investment in plant and equipment, super, or, you know, assets. It's going to invest in something that's going to save on tax but build your wealth. So I mean, that's my ethos, and I think it does lead to a better outcome for the client rather than just focusing on reducing the tax you're going to pay.
Yeah. I heard a bit of a finance guru, I won't name, I think sort of captured this really, really well. He said we're using the wrong language. We don't have an income problem, we have an ownership problem. Is that those sorts of people that you're talking about, it's not that they don't earn enough money to buy the toys, it's that they don't own the right assets.
Yeah.
And that is, investing into super. Super is just a structure, but assets inside super, Australian international shares, so good fund managers that are managing money overseas that you can't access very easily yourself, online. It's those sorts of opportunities, but it's other things. It's like property. It could be a share in a business, but is it an asset that's generating growth and income over time, as opposed to the Hilux, which we know is probably losing value, and in fact you would have a depreciation schedule, I imagine. So you're winding that down, so it's visibly losing value, and again, bit of a tax play, but it's not something that builds wealth over time.
Yeah, so. And it's less of a tax play, and now the instant asset write-off is only 20,000. Most, they're not going to spend that much money on an asset that's only going to be 20,000, so the deduction is lost. But if the instant asset write-off comes back, it's a popular strategy. I just think it points in the wrong direction of where you're wanting to invest your money and your capital. You want to invest it in something that's going to earn you a greater return, or provide you more in the future, rather than just, I don't want to pay tax.
100%. And I mean, look, the goal is kind of vastly different. It's a very different mindset. But I think, again, it's the value of advice and guidance in that. I think it's easy to sort of drive past the dealership, isn't it? And get a bit tempted and go, man, it looks nice, it would be good, but you go to an accountant who has that right mindset and points you in the right direction, can make, a huge difference when you start talking 20, 30 years down the track and you look back at that moment and go, well, that's where I really got pointed in the right direction with the right advice and guidance. If I'd been doing that on my own, well, I think, temptation sort of sometimes speaks louder than common sense. And so, that's when the value of guidance and advice really stands out, I think. The benefit over time.
Yeah, I guess to retrace the steps a little bit, when we were talking before about, I have seen a rise in clients kind of wanting to invest in assets for the family or their children or future generations. So I guess if you could explain a little bit of the structures maybe that enables you to do it. I mean, quite commonly I'll see it'll be just focused on property. Clients are freaking out that their kids won't be able to afford a home by the time they're able to buy. So it's like, let's buy some property now so we've at least got something to pass down. So I guess there are a couple of the issues that I see come up, and it would be great to kind of hear your perspective on it.
Yeah. Look, we definitely know that culturally there are some cultures that are really big on this. Leaving behind cash or assets or property to their kids or their grandkids, which is great. I think certainly the question around property has become a bigger thing in the last few years, given what's happened with rising property prices. Like, it really has become alarmingly difficult, despite the government's attempts to come up with schemes that will work to help people get in. They seem to keep backfiring, and their latest scheme, which the minute they announced it, I knew would have the opposite effect. But it's just made it even harder. It's just created, more demand and added fuel to the fire. But it's really, there's two parts to that. It's if your goal is to path wealth onto future generations, the first, I guess, goal is, okay, we've got to create the wealth. So how do we do that? Right? Is that sacrificing into super over time and building that as a nest egg, right? Is it outside of super, investing into businesses, into property, into shares, into whatever? And then the second part is, if we've done that really well, is, okay, well, how do we funnel or channel that or move that to the family members we want it to go to? And so then you're talking more structures, right? Do we have a trust in place to own all the major assets that we slowly build over time that can feed the family members, right? And stay within the family. And we often, when we're talking about this, use the Rothschilds in the US as an example. wherever the journey started for them, I think somebody had the wherewithal to go, well, let's not just let everyone, have carte blanche access to the big chunk of quality assets. Let's stick them in an environment that's hard for them to liquidate and just get their hands on. It's like a trust or something like that. And let's just give them or feed them the dividends or the income that's shedding off of that to live the comfortable life that they live. But then they had the wherewithal to also have, I think, life insurance policies on a lot of the family members that would then continue to refurbish that general family wealth. And so that's how sort of they did it. And I think it's not a bad blueprint for families who want to do that. Is wealth creation in of itself is the same whether you have that goal or not, whether it's for you or whether it's for future generations. There might be some nuance to that. Somebody might advise you to put more money into one thing over another thing, but still we're trying to do the same thing, is create that pot of money. The second part is a little bit more around, again, you need some good guidance and advice about what are the right structures to make sure it goes where you want. Yeah. And we talk about, say, life insurance. There are things like investment bonds, right? Again, you can access investments. It's a life insurance product. So, one of the issues that we sometimes come across is blended families, right? 50% of marriages fail. 75% of people then remarry. So suddenly you're into a blended family territory. You might have a concern or a need or a desire to make sure that a portion of your estate goes to particular, sons or daughters or family members. An investment bond can help you do that and make sure that the funds don't enter the estate, and basically it's uncontestable. So again, from an advice point of view, that might be not well known out there, but to a skilled advisor, they can make sure that that client can get money specifically to people and ensure that it doesn't get contested by, maybe another party who wants to be aggressive about, getting their hands on that estate. So non-estate assets that are governed by the Life Insurance Act, using, say an investment bond is a fantastic strategy to manage your estate and your affairs. The same with a testamentary trust, right? That is, again, assets moving into a trust based on the distribution that you've, sort of managed through your will. So again, that's sitting down with, an accountant, an advisor and a lawyer to go, well, here's my pot of money and this is how I want it to be distributed, to manage the fact that, some of my family members might be underaged or have a drug problem or whatever it might be. So it's the wealth building part, and then it's get the right advice to make sure that it's in structures that make sure it goes where you want it to, if that makes sense. And I think something we've spoken about previously is in a rising field, which is in the asset protection space, is the patriarchs of the family taking out insurance policies against their kids in case they're needing to jump in, due to a separation or illness, and now need to raise their kids again, and all of a sudden that nice retirement that they had planned is up in the air. So I thought you might want to share some experience with what you've seen with that recently. So again, you don't come across it often, but when those circumstances arise, you can see that there's a need for sort of that careful navigation of the family dynamic. And it's a little bit like, I'll give you an example with businesses that sort of tell that story, right? So, you've got a 2 or 3 partner business. This thing evolved called buy-sell arrangement, and that is, the business takes cover out on all of the various people that's owned by the others, so that if one partner dies, the shares invariably pass to the spouse or partner, who suddenly, you've got this unknown person now who owns maybe a third of your company. And so that was just designed to go to that family member. Look, here's now this pot of money which was representative of your partner's share in this business, but we know you don't want to have any, sort of ongoing involvement in trying to run this business. That was never, your relationship to it. But you obviously need to get that money out, the value of that business out, without us having to sort of either come up with the money, which we might not be able to do, or try and suddenly bring in an equity partner suddenly. And so this concept of this buy-sell, which is similar to the sort of situation you were talking about, that's where life insurance, forms a really important part of a mixed business relationship, to just make sure, again, that it doesn't all fall apart. You've got to liquidate a business or sell shares or do something else, as I described, that really becomes financially messy, very difficult for the surviving business owners. it's a neat and simple way to manage the extraction of the value of the business for the family that sits behind that business owner.
Yeah.
And you know, using a life insurance contract or policy to do that. So
yeah, and I think it results in a win-win situation in terms of, you know, you don't have the stress of the other directors working out how they're going to need to pull this money out to pay out the person. You know, the family gets what, you know, they're happy with or entitled to, and everything can just keep ticking away.
Yeah.
Yeah.
Yeah, 100%. Yeah, like I said, you know, sort of the beginnings of life insurance was really about that. It was about being able to pass on, you know, this little parcel of money to fulfill a need, which might have been, you know, back when, you know, the female partner in relationships typically was very much, you know, reliant on the male in that relationship to you know, survive financially. And if anything happened to them, it sort of meant destitution. And sort of that was the birthplace of the life insurance product, was to, you know, allow the male to go, well, you need to survive on something, so I'll insure my life, and then in the event of something happened to me, you're not now on the streets destitute. You've got something to survive on. And and we've now seen these various iterations of that same concept, you know, move into the corporate world around, you know, protection of businesses and, you know, multiple business owners in the same business, be able to extract their share in a just a really neat, easy way that allows the family to, you know, avoid having to get involved in financial affairs that are just messy and difficult, and allows those business owners to feel protected as well. They can continue to move on with their business. So yeah, again, simple products, but used quite innovatively in some complex situations to get the result that, you know, is sort of good for everyone. Yeah.
Yeah, I think that's everything. Is there anything else?
You didn't have any other? I'm just trying to think if we covered all the. We did SOA.
Yeah.
Yeah. I didn't get to use a really cool stat, which is, it's a bit morbid, but I remember when I first saw it used by an advisor around describing why people should have life insurance. They said every single day, 4 people wake up and walk out their front door and never come home. Every single day, 4 people get up, get ready to go to work, and they never return through their front door because they've died in a car accident. Nationally, that's just representative of the number of people that die every single day on our roads.
Yeah.
4 people. When you think about it and describe it that way, it's quite confronting. When you think about you getting up and getting ready to go to work, and what if that particular day I was one of those 1 in 4?
Yeah.
What impact does that have on, because I'm not here anymore, the people I leave behind?
Yeah.
And it's a bigger the number than what you think. You think, oh shit, every 4, you know, every day 4 people just never come back again. 7,000 people every day actually have something happen to them that requires some form of hospitalisation. 7,000 people every single day. And it's this thing about, you know, if you don't think it's going to happen to you, do yourself a favour and just go to the hospital, because it is full of people that didn't expect to be there, but just found themselves in those circumstances. And that's what you're going to think about. They didn't think it would happen to them either. The difference is, did they plan for it? Did they have that safety net? Are they going to be okay financially, so they don't have to worry about their money right at the very time they're most focused on their health and getting well again? And it's quite powerful to talk about it in those terms. With people who, and young people do, unfortunately, they're the most in need of the cover because it's cheap, they're healthy, it's easier to get, it sets them up for the future when sometimes it can be hard to get it. But they're also the people that think they need it the least. So it's about trying to manage that tension as well.
I think there is a difficulty with it as well, because the realisation of when you need it is probably the time when finances are stressed the most, is when you have a newborn child or you're a young child, and it's like you may only have one income, so it's like, well, this is a time I definitely need it, because if something happens to me on that day, you know, there's nothing left. So it can be quite challenging, and that's why sometimes it is better to do it before you go into the process, so you've got something. And,
absolutely.
You know, the budget's kind of set that, you know, okay, that's taken care of, and you run the numbers, you know, okay, what am I going to need to kind of pay off the mortgage, school fees, living expenses also. So you just know that money is going to be there and everything's going to be okay.
Yeah.
If you're that 1 in 4, unfortunately, you never know when your number's going to be up. But I think that assurance that everything will be okay, that things are covered, and that situation of that there's not going to be that financial stress that you're going to leave behind.
Yeah, 100%. I think it's the right way to contextualise it for people is rather than saying how much money do you want to insure for, is to say to them how much, not how much, what do you want to protect? Because it's often that thing, I want to protect my wife from having the bank, call up and say, where's our money, sort of thing. Or I want to protect the fact that my kids are going to be able to have their education paid for by having, that, again, an extra bit of money set aside. So, because invariably that's the question that gets asked as well. Again, I conceptually get it. Now, how much do I need? And so there are some very simple rules of thumb. We often use just a simple calculator. Income protection is straightforward. You always insure the max, which is 70-75% of your gross income. Again, there's some other bells and whistles that an advisor can help you understand, or someone who can give general advice. With life, it's often about, cover your debts, and if you don't have kids, just make sure your debts are covered, and maybe, some extra for funeral costs and that sort of thing. If you've got kids though, that's a different proposition. It really bumps the number up, because it's like, well, if your kids are under 10, they're basically, they're not adults until they're 18, or they're financially dependent. We sort of say until then you would expect. So if your kids are 4, 5 and 6 or something, then, there's 10, 12, 14 years of your income that you're kind of expecting to earn to get them through that. So you multiply, sort of 75% at least of, 12 years of your income. That should go onto your life cover as well if you're really wanting to make sure you're properly covered. But again, it's not hard to kind of figure it out. And then you just massage that to get it back to where you can afford. But it's not a hard thing to do. I was also going to say, when you talked about cover and no, I think we did cover it. Important part of financial planning. No, cool.
I've got to record my disclaimer that I forgot to do.
So you're going to have to do that and then have it bolted onto the front.
So everything we discuss is general in nature, and if you're looking to implement any strategies we discussed, please see a professional to get advice that is specific to your needs.
Beautiful. Thanks for having us today.
Awesome. Thank you for coming along.